Okay, so we're recording. It looks like it's picking up. Sometimes I forget to turn the mic on. It looks like it's picking up the mic, so we should be good. Yeah, I'll talk about rolling a strangle, and we could talk. I'll talk about anything you want to talk about. I know I guess the main point was to work on inverted strangles, but you have to remember these things are, they're all kind of intercorrelated, and I say them even in my book. I think it's stupid the names they have for these things, but I guess it's easier to call something a strangle than I'm a short a put and short a call. So yeah, we'll talk about anything you wish. I think what I'm going to do something a little more. I didn't mean to bring that over there. That's that. I'll leave that there. I think it's important that everybody understands. And I think we all miss this when we started trading. I just started another course, and it's what I wish I knew before I was trading. And I think there's a lot of things that if we had the kind of knowledge that sometimes takes a long time if you're not really focused on it, on intrinsic value and extrinsic value. You'd hear me talk about that all the time, and from my perspective, it's so important in options trading, and particularly when we get to if 50% of my trades are strangles. We're trading strangles, undefined risk trades, defending them, and when to roll, when not to roll, or at least what I think is important. So does everybody have a pretty good handle on extrinsic value? I want to show you something on any options platform. You can always do the math. This isn't a very good one. Let's bring up one that we're not too good on. Let's look at Meta, and we could go one that's gotten deep in the money again. But for a couple things, I even mentioned this morning that there was a stock went ex-dividend, and not part of this conversation, but since we're on that, it'd be good to know if a stock goes ex-dividend, you don't have to be concerned with it unless you have short in the money calls. Now, if you look here on this Meta trade, I'm short the 172.5 call. And you could do the math and figure out what the intrinsic value or the extrinsic value, but a real shortcut on any of these platforms is just slide over here to the corresponding put, and you'll see that there's 23 cents worth of extrinsic value. This particular stock does not have a dividend, but if it had a dividend and that dividend was higher than what the extrinsic value, you're at real risk for assignment. And not only, the big thing is not getting assigned, but paying that dividend. And it happens to me. I get complacent, and I don't know. I don't watch what has X dividends. Tastyworks is good about reminding you if you've got them in your account. But that's you think, oh, okay, well, I'm short at 172.5. I can cover that or whatever. But if this thing was $3 or $4, now you're out $300 or $400 on a dividend. So we won't. I'm happy to answer questions relative to that today after we talk about the inverted strangles and all that stuff. But what I wanted to show you is always be cognizant of what the intrinsic and extrinsic value is, because it's really, really important. Didn't mean to do that in when to adjust trades. I think it's important to adjust trades because, and we'll talk about here on some of these inverted strangles, because most of the time, let's just take this one here in Meta. If we were going to buy that back today, you can see that this one's got a 17.5. It's got a 17.5. It's not in the money. I want to show you one that's in the money. Let's see here. I know I'm going to show you. This is one I've been fighting for a long time. Okay, this is a good example. This is an inverted strangle on Alcoa. Now I've been, I'm not following my own rules because this one I've got about $500 or $600 in premium or something more than the inverted. I've just been messing with this one forever. But when you look at an inverted strangle like that, and now that's $5 wide, you can see right now that the cost to buy that thing back or to close it with 4 days to go is $605. So that means this is, as long as prices between these two strikes, it's always going to be worth that spread risk. Now, I'll show you some other examples, probably on maybe on something like Meta and that have a much higher IB, and that number will be a lot bigger. When your IB rank gets way down, you start losing less and less. What I do on trades like this, and I left this open to show you, I would take this trade, say, okay, it's $5 to close it, as long as price stays in between here. I'm gonna put a price to close, let's say at 520. And I'm paying 20 bucks more than it's worth. I go good to cancel. And I have that sitting out there that I can watch that every day, and I can see when that gets closed. And when if I'm in a position like we are in several where we're in an inverted strangle, we haven't accumulated enough premium to cover the spread width, then you may want to continue it. You know, if it's close, you want to just get out of the trade, that's fine, and we can talk about that. But in a case like this, I've collected way more than $5 in premium. So if price stays in here this week, I'll close that. But what you should know is most brokers, I can't speak for all of them, I can speak for Tastyworks. If I forget about this and prices between these two strikes at the end on expiration in 4 days or whatever the expiration would be, they'll close it for you. It'll be cash settled for $5, which is that intrinsic value of that inverted strangle, and you'll be at probably a $5 assignment fee, something like that. But that's what most brokers do. So it's not, if you don't forget, it's not the end of the world. But what I like to do is put like on all my trades, I always typically have a working order, so I can keep my eye on, on where it is. When this thing starts trending down, it gets down to, if I wanted to stay in this trade because I wanted to roll it for another week, and it got down to, around, 525, 530, then I know there's only 30 cents left of intrinsic value. The difference between, whatever the mid is. Right now there's $1 of extrinsic value. So, I'm in no rush to, no rush to change that. I'd rather let that buck come out. So, but if it gets down there, without having to bring it up all the time, I can just look on the screen there and say, okay, it's down to like 530, 540. Maybe I'll go ahead and roll it out. So it's important to know, what the intrinsic value and what the extrinsic value, because if we go to something like Meta, which has now gotten, we're out of whack here. Let's just say I haven't done it yet, but hypothetically, there's only 4 days left in this trade. I had rolled to the 187.5, and if the inverted strangle was the 187.5, and I had to buy it back, that's what, 15 points. See, right now it's 18.25. So if price is in there, I'm not gonna pay $3 more necessarily to close that thing than I know that it's worth. I mean, it's like buying something that the value is $20 and you're going to pay $25. It just doesn't make a lot of sense to me. Now, that goes out the window when either of these are breached, and we'll talk about that and hopefully answer all your questions on when to roll and everything. But as long as price on any of these inverted strangles, as long as price stays between the short strikes, that's really what you want. You want every day, you want that theta decay to come out of it. Just every single day you're going to lose. This one, $40. See, $41? $41 a day that's going to come in. So by the end of the week, that'll be worth $15. So you got, $3.25 divided by 5 days or whatever, 4.5 days. So that's really important. I always ask, when people ask me questions, what I've learned to do is I always like to keep track of how much premium I've accumulated. And I can show you what I do on my spreadsheet, and a number of you have that. But I think it's important to know what your total premium you collected, because your mission should be on these inverted strangles is not to dance with them for a long time. You put these on as a regular strangle in most cases, and because it got blown out on one side or the other, you've made one or more adjustments. My mission is to get out of these for a scratch or better. If I get lucky and I collect a lot of premium like I have on Meta right now, and I get out for making a few bucks on the trade, that's all well and good. But my real mission in life is to get the heck out of these things. So that's why I talk, and I think there was a couple questions last week. Somebody wanted to roll out for 3 or 4 weeks. I like to keep them close, and we'll talk a little bit about that, how what I like to do on these things. But so I think you should always have a handle on what your how much premium you've collected. If you see I'll slide this over here real quick. This is my detailed trade log, and I pick up these positions and I plug them in there. So I keep these up. As long as I keep this detailed trade log up to date, it updates my the net premium. If you look at this column I just highlighted, so I know that on Meta I've got $841.60. That's net of commission. So you should always know those numbers because it can make a decision. If you collected $8 and you're down to where you can buy this thing back for you might want to buy it back for $8.20 or something, and lose $20 and move on to the next trade. That's why I think it's really, really always important. If there are any questions on extrinsic and extrinsic value, the intrinsic value is what it's worth. Like I explained to here, you got a spread width of $15. It's always going to be worth $15 as long as price stays between. Now, all these strangles, all these trades, these start out not as inverted strangles. I mean, our mission should be not to have any of these, but I think I've got 4 or 5 right now. And what I'm hoping I can convey is, don't panic about them. Try to manage your way out of them, because most of these are manageable, to some degree. And I see a lot of. I'm going to pick. What was the original trade on this thing? I know it was way down there. Let's see. When do we put this meta trade on? Been that long? Yeah, it looks back on February 1st. We sold the 125, 175. So I'm going to do a different week so it doesn't get all confusing. So we sold this 125, 175. There. Okay. So that was the original trade. Obviously it was on the February 24th expiration, but that's kind of what it looked like. Now, when we put a strangle on, we're typically, somewhere around the midpoint of the pricing. So there's 0 intrinsic value, and it's 100% extrinsic value, because it'd be a better example if I put this thing in the money. So let's go up here to 200. I don't want to confuse everybody. That's 200, just for example. So we've got a 160-200 strangle. So you can look on your chart. It shows you're collecting $135. That's all extrinsic value. That's all junk. That's what we sell as junk, and we're hoping that 135 turns out to be 50 or 60, and as the theta decay takes place every day, and we buy it back. So any strangle, I can't think of one that you would do that has intrinsic value, and everything should have 0 intrinsic. It'll be 100% extrinsic. So that's kind of where we start, and then of course trades go wild, and we end up with some of the things like we have where they get inverted. So I would implore you to know, you don't have to do it on a spreadsheet like I do, but you could, if you just have a spiral notebook next to you, and every time you make a roll, just write down, meta, $2 or 20 cents or whatever. But it's a good idea to know how much premium you've collected, because that'll help you make some decisions. Because I've even get into ones that I'm not paying attention for a while, and all of a sudden, it might be an inverted strangle that's slightly outside 1 or 2 of the either one of the short call or the short put, and heck, I've collected a lot of premium. I just go ahead and close the thing, So that I would say that it's, and you'll see me ask it every time. I think it's really, really important to know how much premium you've collected, and then always know what the extrinsic value is. Now I want to talk a little, just for a second, about lows, because we recently did a strangle on lows, 92.5, and I'll talk about any other ones, but that was the March 10th. That was this week. So we did we got out of that today. We did this 92.5, 220, which again was 100%, it is today 100% extrinsic value, because it's both options, neither option is in the money. So now that one was threatened, and we talked about a little bit about last week. And what I wanted to say again about knowing how much premium you collected. In this case, we collected about $2.30. So when this thing started getting down and kind of pressuring, I think it did break under 192.5. I don't panic at the first break unless it's a real material break, $4 or $5 or something, and I don't panic, but I don't react is the proper word. But when this gets down here at 192.5, I think we all got rid of the short call with the intent of rolling it down on an up day, which did not occur, I guess, till today. But you can know that, okay, I got $2.30, and even though the cost to buy back this 192.5 short put at the time might have been way more than your premium, that it's got a ton of extrinsic value in it, and it's probably going to, over time that's going to come out, because a lot of people seem to want to react when the price of the option the price of the option gets threatened, gets tested, and of course the price to buy it back goes way up. There's a ton of extrinsic value in it, either because the implied volatility's gone up way up or not. But I caution you not to overreact and want to micromanage these things to the point that you're just kind of moving them every single day. So if we had caught this a couple of days ago, this might have cost $4 to buy that back, this 92.5 put, and you looked at it and say, oh crap, this thing, I've only got 230, I'm down $170 on that. But the reality was, it might have been at 192, it might have been 50 cents in the money or 20 cents out of the money or whatever. So I don't overreact when they do that. Particularly stocks like Lowe's that are pretty solid and all that, you really don't have to worry about them. So I wanted to caution you. I think it's most important to get out once we go inverted. If we, the majority of our trades, we're going to put them on like this. They're going to hit our target. We're going to exit them. We're going to move on with life. The ones that we have to manage and get inverted, those take a little more time and patience and probably a knowledge and experience. But I think the important thing is to know where you stand and not to overreact and not to want to roll them every single day. And I'll talk a little bit about neutralizing those deltas also. But that's the most important thing, I think, is to know how much premium you collected, know what the intrinsic value is, what the extrinsic value is. You want to get rid of all that extrinsic value. Now, as far as managing these things, let's find something. Maybe we can even talk about coin, which I put on today. Okay, coin, and Jan, I see your question, and Robert, I'll get to those, but let's just be theoretical here and say that, let's just say that, for instance, this thing tanks and it breaks the 45. Now I've collected $2.70, so my break even is 45 on that side, minus 270. So it's 42 and a half, something like that. So I had that in mind. So if it just goes down there and kind of gets below, kind of plays around, I might wait a day to see if it bounces back up. But if we do want to roll it, once this is breached, it's convincingly this is broken, breached the 45. Now I'm aggressively rolling down the call side, and I'll tell you what I do on that. If this price comes down and it's bouncing around 45, and just above it, you're okay, but you're just buying time because, it costs $2 to buy this back, and maybe you only collected $1.50. It's a losing trade on the surface, even though it'd be out of the money. What I like to do is I like to neutralize, and you'll hear me say this, neutralize the deltas by 50%. This won't be a great example, but what I do is I'll take the tested side. In this case, and I think I've got some that I can show you the real world. Right now, this has only got a 12 delta. Obviously, it's way out of the money because it'd be a 50 delta if it's in the money. But let's just say, you know, we were up here, and now this thing's getting threatened, and now we're a 33 delta. If I got a little bit of an up day, what I would do by neutralizing the deltas, I'd take that number, cut it about in half, and I would see, I'm going to put that there, I'm going to see what it would cost, or how much premium I collect to go down to, say, the 16. This is a 33 delta. Put that on there. That 30, it's got, or this, I'm sorry, 60 strike, 33 delta. So if I wanted to neutralize the deltas by 50%, and the reason I don't go all the way down to the 33 and make it a neutral strangle again is you tend to get whipsawed. I've learned this over the years from with Tasty Trade. They typically like to neutralize them by 50%. So I would take this, an up day like today, I'd probably roll this down to something like that. Let's just see what we would collect. Because I want to, you want this to be worthwhile. That 82 cents, that's not too bad. So now you would have a 145 strangle with $1.85 plus a $2.67 in premium. So that's all there is to neutralizing deltas, and vice versa. If it goes the other way, let's say the call's threatened, and let's just say we're down here around this 8. We sold the 80 and it's 35. On a down day, I prefer to do it on a down day, but sometimes you just can't do it. I would be rolling this from 35 to 17. I might roll it up to here, but only if it's worthwhile. I'm not going to increase that, by $5 if essentially give myself more risk if I'm only picking up 10 or 20 cents. I got other stuff on here so you can't see that. So it's really as simple. It really as simple as that. How I make a decision whether to roll the untested side, and the untested side obviously is the side that's not tested. So let me look at your question here, Jan, and then we can get back to some other stuff. Let me drink of water. Okay, let's take Jan's example here and see, maybe that will answer some questions. And then let me know what other questions we have. And okay, so your March the 3rd expiration, is it correct to switch? March 3rd is already passed. Is that or that was what the original trade was? The original trade was the 150, 185. Oh, okay. So yeah, I can't look them. So you originally had a 185. You had a 185, 150 strangle, something like that. And then it hit 190. Okay. So what you're not too, you're okay to 190 strangle. What I would be doing first, depending how much premium is 840. Well, you're in pretty good shape then. So, obviously the first thing I would be doing is I'd be rolling this up. I would leave the 185 call intact. If I'm rolling it up in the same week, if I'm rolling it out, I may adjust the call. So now I would have a 195, 185 inverted strangle on, and I probably have more than $5 in premium I've collected. So now you're saying you've got a March 17th 190 short straddle. You got that on 22.45, correct? And you've got 840 in premium. Yep. Okay. So, well, this is the same thing. There's two things you could do. You're a little slow, and I don't mean to be critical, but you need to be aggressive on rolling these things. I've learned that the hard way. You've collected 840 in premium, so let me take this off. So let me check. The first thing would be buy the 190, and if I sold to 207.5, I collect 465. 465 plus your 8 only gets you to about $13 with the 17. That would probably be my first move. I would, especially today, I would run a rolled up. The other thing I would look at, and like I try to be more aggressive rolling the untested side. But right now you're sitting, and let's just assume if you bought back this straddle, you've got to get up around the money somewhere. So I would first start out, and this should answer some questions. I usually like to just go out a week at a time, if at all possible. So you got 22.40. Price is at 210. Now this is where it would depend whether I was bullish or bearish, because I would slide this one way or the other. But that's you're paying 54 cents, which isn't too bad. You've got a $7.50 spread, and you've collected more than that. Short term's bullish. Okay. Well, if short term's bullish, then what I like to do is I'm going to delete this. I like to look at the money. I would probably place the call here just slightly out of the money rather than at the 207.5. Then I would sell the put, whatever it takes to make this, zero or close to zero. I mean, that's a 32-cent debit. You could do that, or you could go up to here. Now you've got a $10 wide. You've got $140 in premium. So that you've almost got enough premium to cover that inverted strangle. That's how I would do that. I mean, I would do one or the other. You could either, if you want to spend 20 bucks out of your premium, that's probably a little better. But and I know I was asked by Clyde today, I think, but like in the case of, I'll go back to yours, 190 straddle. And then, see, I would look and I'd say, okay, if I was neutral, I would probably kind of center price, whatever it took to get this to a credit or, something like that. But if you're bullish, I would position the call just out of the money. I mean, you're just out of the money, and then I would just the put that I picked is nothing mechanical. It's only I'm just trying to pick a put that gives me enough money to cover to give me a credit or zero. This one's 15 cents. So now you spend 15 bucks. You got a $7.50 wide. Yeah. Well, you don't know. I mean, you have to do what's going to happen, what you think's going to happen today. If you think it's going to, okay. Yeah. So I mean, your choices are to be neutral. It's trading at 210. You just have to kind of play around with. There's no wrong answers on this stuff. You could kind of play around. There you get a 97-cent credit. You'd be a little bit in the money. So if you're neutral, you do something like that. If you're bullish, like I said, I would pull this up. I would put it to the 210. Again, you could do either one of these, but I like to keep the call. If I keep the call of the money, if I'm that bullish on it, then I just slide this put to wherever it gives me a credit or a very, very, very small debit. You can do either one. At this point, you kind of your die's cast. I mean, what do we say if you roll this up, you buy the 190 back, and you're bullish, I'd sell the 110. So now you'd have the 210 190. You'd pick up about $6, so you'd be at 14, and then you could wait and see, later in the week or next week. So let's say you did that and picked up the $6, which is fine. Now you got about $15. You're going to be about $6 in the hole. But let's just see. You remember, the front week's going to lose value faster. So if now you've got this on and this on, we're going to buy those back. If we might have to go out 2 weeks. Could I go out a week and go let's say middle of this thing again, 20 wide. See, you could do it next week, keep it in the middle, pick up another $1.56. That's one way to approach it. Yeah, and because your put's gotten so far out of the money, you need to be more aggressive rolling that up, but you are where you are right now. And I mean, I'd be fine with rolling. I would be aggressive. I mean, I wouldn't, I would be fine rolling this up. Your 210, I'd be fine. I'd roll that up, pick up $6. Now you've got $14. Then when, what I would do then is I'd have a order to close this, just like I said earlier. And right now it's at $28. And I'd have an order sitting there. And when that got down to, if price stays in between here, between 190 and 210, when that thing gets down to about 20 and a half or 20.25, that's the time to roll it. And, because right now you've got $8 worth of extrinsic value to burn out. And if you roll this now, to the next week, you've got a good chance that this whole $8 is going to be gone if this price stays in here, and you're going to want to stay in this trade because you still need to collect more premium. So that's how I would, that's how I would do it. So does that answer your question? I mean, maybe to answer some other questions too, or if there's any confusion, let me know. Let me a second. I just got something hit on my what's going on here, and oh, okay. I heard something go off in there. So that's what I would do it. Yeah, I like that. I mean, that's how, of course, I would have been, I'm not picking on you, I would have been quicker, but that's where I would be. I mean, I would have been rolling this, maybe it got here, I'd been rolling here and then here and then here. I would roll those puts up as long as that thing's going up, because you need all the help you can get to hedge this side over here. That's why I mean by being aggressive. I learned the hard way. I used to worry about how much premium I collected and what oh God, I've locked in a $3 loss and all that. But it's and then let me know. I mean, you always pop in there what you know, but that's what I would do. And I just sit there and hope that it stays between 210 and 190 for another week, and then roll. And you'll get a lot more money if you can let all the extrinsic come out of it and then roll it. So, okay. Well, maybe that helps some other people too on that. You're welcome. Okay, Robert, now maybe this will help some. Please pop in any questions that you guys have. Let's see what I did with the chat from this thing. Got lost. Okay. There it is. I'm going to move this up here so I know where it is. Okay. Okay, let's cover Robert's question. And then I want to go over some that I have. I have some real, I've got some beauties right now. Let's see. Can you talk about rolling a strangle one and what delta? Robert, either type in the room. Well, first of all, I don't roll a strangle until one side is breached. Strangles, if I have a strangle on, and I've got, let me find one here that Chewy's in the money, cost round of CRM. I just Google, darn it. Trying to see if I have any. Yeah, I just have a few that are in the money. Okay, let's come up with a hypothetical strangle again. I've got this iron condor on Apple, but it could be a strangle. Let's just say it's the 140, 165 strangle. Now, as long as price stays between those, I really don't do anything. I never roll a strangle unless one side or the other is breached and I've had to adjust it. So, first part of your question, when do I roll it? Well, I really don't. The only adjustment I would make on a strangle that is still both sides are out of the money, whether it's sitting right at 140 or right at 165 and touch it, I don't roll those at all. I just let time come out of them every day. I mean, my first goal is to hit my targeted gross profit, my targeted net profit, either 25% if it's a matter of a couple of days, or our basic are 50%. So if it hasn't achieved that target in a period of time, it just sits in there. I just let it come out every day. I mean, I know people have a tendency, and I mentioned it earlier, once these things start getting challenged, if you right now, it's trading at 155. If we had the 150 was our short put, I mean, that'd be $3.45 to get out of it. You would probably be upside down, but the trade is still out of the money. So the first thing you want to look at is say, where will this trade be if it expired today? And I'm not suggesting we keep them until expiration, but what I'm saying is you have to say, okay, right now, this trade, let's see what it costs to put on. I'm going to see what this one cost. Just the short strikes. I've got a strangle. Let's see. Okay, it costs. I collected. If I would have put that strangle on, I would have collected $4.65. So, let's see. If I buy it back today, it's $3.15. So, it's not quite to my $2.30 profit. But I think this answers your question. There's no reason to roll that. I mean, there's no reason to roll that. If it starts going down here and testing this side, you've collected $4.65. Your break even's down around $1.35. I don't panic. When it. I don't want to use the word panic. I don't. Get too concerned when it breaks out. I kind of want to make sure, a stock like Apple will have a tendency to maybe break that 140 and it kind of bounce back, but you don't know, and you have to be mechanical. So I may let it go for a day and see what it does. But what can happen is that as price goes down, and this was like that the other day, this thing was trading around 140. These go way up in price, so they're losers, but they're not really losers because they're all extrinsic value because they're out of the money. So, so first of all, I don't roll a strangle, even if I'm inside the 21 days, which will happen. I just sit there and wait it out. Now, once I get inside the 21 days, as soon as it becomes profitable, I will exit it. I mean, and maybe put one on for the next month, maybe different strikes, but that's it. So I think that answers your question. I just don't roll strangles just because they're on the surface, they're losing trades. They might be losing trades because you put them on for 465 and the implied volatility rank went through the moon. This one's down to 10. But if that thing went way up, then your options would cost you more to buy back than you sold it before. So that's one thing. Now, your next question here is about inverted. Once inverted, do you continue to roll up the put or down? Yeah. What I would do, kind of like I was telling Jan there, to a certain point. Let me see if a trade I got here. Coin cost, AMD's one. Okay. Yeah, here's AMD. I've got a couple cheap wings on, which I should take off. I put them on over the weekend. Okay, here's an example. This is inverted right now. So this trade started out, let's see when it did start out so we can, I think 131 for $1.67. And let me bring up my, yeah, it started on 131. Right now I've got $400 in credit premium, $3.90, $4. So right now, my mission on AMD is to get heck out of this trade. Now you can see the 81, and if I'm lucky, I get out this week. Remember, I got, say, $4 in premium. Let's round it up to $4. So right now, The call I can even close for less than that, but I'm not going to close that because the put's out of the money. So what I would do on this one, I wouldn't do anything yet. I've collected $4, so I know my break even is somewhere, up in here somewhere on this side, and we're pretty close to the break even on the call side. It's 350 or 79 plus $4 is 83. So that's about my break even. So now this is an inverted strangle, but let's just say this thing keeps going up. Now this week I've only got 4 days. I will continue to roll this up. In this case I would roll the puts up, but with only 4 days to go, I would be more inclined, now that this has breached this, I would be more inclined to buy this back, and I'd look out a week and I'd say, okay, what can I do for next week? Am I bullish? Am I bearish? Am I neutral? So I could start out, so I could put the same trade on, say, which I wouldn't do, 79.81. We wouldn't want to do that, but and I could collect $1.74 credit. But what I'd probably start out to see how close could I get. Now look, I could do an 81.82 strangle or inverted strangle and pick up $1. So I wouldn't do that. I'd bring this thing out of the money. Okay, now I can do an 82 straddle and still get a 44-cent credit. What happens if I go like here? I would probably do that. For a 4-cent debit to go to a regular strangle, so I would do one of those two. That's what I would do. And again, it depends. If I was really bearish, like I was on Meta when it got up to 175, that comes somewhat into my thinking. But so that's basically, it's really that easy. I mean, that's what I do. So let's see where Meta is, because I think that one got. I was gone Friday afternoon, and this thing went up $10. So now Meta was hovering in here on Meta. Now I've got wings on Meta because it sucked up a lot of buying power. So but we're just going to talk about the strangle portion of it. Okay, Meta, I got $841 in premium I've collected. It's been pretty juicy. So, but now the IV ranks down to 7, so there's not going to be much opportunity there. What I'm going to do on Meta, this probably falls into your question. I got to do this today. You see these are 43 cents. These puts aren't helping me at all. So I'm going to be buying that, and I'll probably go there to 85. I could. So I'm rolling up $10. I'm taking on $10 more with the risk, but I'm getting $2.52. And I can't remember how much premium I had. So I got $2.50. So I'll be up to about $11. So that gets me. I've got a 12.5. I would have a $12.50 inverted strangle. I've only collected $11 at that point in premium. So I'd probably watch it for a couple days. I would put in an order for say, I put it in here for $12.25, just as an example. And if I could buy it back for $12.25. So I have it over here in my order. I can keep my eye on it. And once that I know it gets down close to $12.25, and I know that I haven't got enough premium to close this thing out for a profit or a break even, I'll buy this back, I'll go out a week, and I'll say, what can I put on next week? And am I bullish, bearish, neutral, whatever? I probably start out, I usually start out with something like this, just right at the money. And I know I have to spread that a little bit. So now again, there's no wrong answers there. Now I've got, okay, so now I've spread it to a 180, 192.5, which is, I'll point this out when this comes to mind. I never want to increase the width of that inversion, because every time you increase the width of the inversion, sure, you pick up more premium, but you only get paid about half of what the extra risk you're taking off. So if I go for $1.24 here, and I go here to 177, I'm getting $1.80, but I took on $2.50 more in risk. So that that doesn't work. So that's probably what I'll be doing here. Now I'm up to probably close to breaking even. If I can't keep the spread the same, and again I want to be as tight as I can be, but Obviously, this thing's got out of whack. So we're 12. I'm probably more bearish on this. So what I would probably do is put my put there, and I would probably adjust it with the call side, something like that. I could do that for a $10 debit. I would probably do that. But it's not going to be that much because right now this one's still got a lot of extrinsic value in it. So, and this is all. I mean, I don't know anything. I'm just thinking this thing's been through the roof. It's going to sell off. I might be wrong. If I'm, I could go neutral on it. Kind of play around with it. Here I've kept the spread the same. I'm picking up another $1.23. And what do I have? And I'll pick up more than that because the extrinsic value of the March 10th will be gone this week. So cause I want to show you that. I'm going to show you something here. Right now we know that the one I was going to go to, that one right there, is 12 and a half. No, I was going to go right there. Excuse me. That's $15 spread. And it's 18. So there's $3 of extrinsic value. So if I did the same thing the next week, 72 and a half, let me remember the number, 72 and a half, 87 and a half. See, it's $20. But that $18 one will get down to 15 a lot faster than this 20 will go down to 19. So if I can wait as long as possible on the front week and let all the extrinsic come out of it, then I'm ready to roll. Then I'm gonna maximize the amount of money I get, if that makes any sense. So, but also, like, don't be complacent on this one and say, boy, I hope this thing comes back, because what I'm going to do right now is roll this, and I'll post it in the room. See, it takes another $750 in because of the width. Okay, that filled. I'll post that. I'll post that in the room. But let me do that while I'm thinking about it, or I'll forget. Let's see here. So my wishful thinking of being out of meta this week for a nice profit has kind of been dashed by that move on Friday. Let me put it here. Okay. Let's see. Okay, Jade had to leave. What other questions you guys have? I'm trying to think of what I wanted to make sure that you had an idea why I traded. I'll look at some other ones here that I have on, and maybe these will help you. Right now, I've got the 50, 55. I think we talked about this, the Alcoa. I've got a working order for 520. If that hits, I'll be out of that thing. So that's an inverted strangle. Apple is not. AMD, we talked about that one. AMD, I'm really close. I'm hoping we get a little bit of a pullback. It gets in between here. I should have an order to close that puppy for $2.20. You can see right now it's $4.80. If it gets back inside, it'll be $2 by the end of the week. I'll put that in there. Now Chewy's a little different, and I could show you something on Rivian that I've got going on right now. What I've got on Chewy, I've just been assigned to stock a couple of times, and what you should think about when you've got a deep in the money put like this one, it's trading at 40 and it's $9 dive. I don't know if I think that might be a last year trade. So let me see if I know how much premium I've collected. Yeah, okay. Yeah, I'm at $43.95 because I was put to stock, so I haven't adjusted that one. But what I do on these, I can either go inverted, like that, and just like we've talked about. But what I'll do sometimes on these, I just assume this 40, this is 97 deltas. So that's basically 100, 97 shares of stock. So what I'll typically do is I'll sell a weekly call against it. Now see, this is every week, and I'll keep moving it, maybe move it up for as long as I could do it for a credit. And I'll eventually end up with a inverted strangle the same way. But that's really kind of like a covered call, just a little different way to play it. Just assume that you're deep short in the money put or call, and if it's on the other side, that's long stock. If you've got a deep in the money call like we do in Meta, that's short stock. And if you want to sell, some people want to be more active, you could sell weeklies against it. It's probably a lot simpler to just have both options in the same week. Sometimes like I said, I kind of play around with them a little bit. CRM. I did. No, that was last week. Yeah. This will be a little bit of an educational opportunity. This was a 205 strangle. I bought back the put for a nickel. And I added this call down here. So let's forget it. I did that for buying purposes. I've got the buying power back so I could take it off. But let's just say $2 and 205. And let's just say this was the remnants of that strangle. We closed the put side. Now we're short the 190 call, and it's cost $273 to buy it back, $275, and we've only got $2. So we're going to lose money on it. But what I want to point out here, like I alluded to earlier, is yes, it's a losing trade. If I close it today, I'm going to lose money. And there's no question about it, because it'll cost me 75, 80 cents more than what I've sold it for. But look at it. Where's this thing going to be? It's out of the money. Where's it going to be on expiration Friday, which is a week from Friday, if it hasn't moved in our favor? And the other thing to look at is look at the extrinsic value on this call. So this thing, even though it's worthless, you got to pay $2.75 for it. So that's $6.45, $6.50 in extrinsic value. So that would be one. I would just sit there. If I still had the strangle on, what was it? The 140. Obviously, I would have been more aggressive, but by now I would have rolled this up, assuming we're about 37 deltas there. On a down day like today, perfect day to roll it, I'd go around. Let's see what the 18 delta looks like. So if I bought that back, I might not be that aggressive. I might say, I kind of stay at a 175. There's no magic number. I could pick up $1. So I might do that. And I know, Robert, you talked about rolling a strangle. I still would not roll this strangle. I've got 11 days. It's inside our 21 days. So the criteria tells me to roll them. I would do it for sure on a defined risk trade. The fact that I've got a trade that has a decent probability, 63% of closing out of the money, I would not roll this strangle. If you want, if you want to roll it, and let's say you've already done this, you buy that back. I'll typically go out a week, and I'll center the thing again. It'll be a neutral strangle, so I'll probably have to go. Let's just see, 34. Yeah, I see. That's 217. Rather than getting the premium, I'd go wider. Let's go here. Let's just see what. That's too wide. 22. See, that's a 20. That's 21, 22. So that's a neutral, but you're paying a little debit, so I wouldn't do that. So I pick a side. I either go down with the call or up with the put to get a credit or zero there. But that's how I would roll a strangle. And you can roll them, at the 21-day mark. But what I do on undefined risk trades, when they're out of the money like that, chances are it's probably going to bite me in the butt. But I can deal with that. But the fact that it's out of the money, I'm just going to watch it, and I know that I've got $2 in premium. This thing, could go down, and like I said, I closed the put side, but if I may go ahead and put this put on today. That gives me another dollar. Oh, that doesn't. If I hadn't closed the put side, it would be 140. I'd buy that back. So I'd pick up another $1.73. So now, I got some, now I got almost, what, $3.70 in premium. So that, on the 21 days to expiration, I'm very mechanical about rolling the, if I can't exit a defined risk trade, an iron condor or a credit spread, if I can't exit it for a profit or a zero, and I can roll it for a credit or zero, I will roll it at that time. If I can't, if it's still, and I think I've got some of those, if it's still in the money, see, there's nothing I closed one of these today, but this one, there's nothing I can do on this one. I can't roll it out. That's a different spread. They don't have the $2.50 wide yet. So I can't roll it out for a credit. I wanted to see if I had one here that was. See, this would be an example. Of course, we're not, we still got 3 weeks to go. But, 21 days, 3 weeks. This is out of the money. I sold it for $1.70. It would cost me $1.93 to close it, but I'm not worried about it. It's out of the money. I mean, it might go in the money, might go out of the money. I don't do anything with this thing until the 21-day mark. Then if it's in the money and I can roll it for a credit, I do that. If it's in the money, I can't roll it for credit, I wait till I can roll it for a credit or exit it. Pretty mechanical. Let's see. CRM. I wonder if I could show you. Yeah, again, the fact that this trade is in the black and only got 11 days, but as soon as this thing closes, 192, I'll be rolling it. So I'm trying to see if we have something we've got on in the room. Okay, here's a Microsoft Iron Condor. Let's see what we sold that thing for. I sold it for, that's not the one. Here it is, up here. I sold it for $1.80. We just put that on the 15th of February. So I should have what I should have is a good to close order on this. So let me set that up first at 90 cents. So this is slightly profitable, 40 cents. This particular trade will hit the 21-day mark this week. So, you could basically, if you want to take the profit now, you could do that, or I'll wait it out a few days. So, because it's March 31st, it's 25 days to expiration, so this Friday will be 21. NVIDIA, I think that's in the money. Okay, let's see what this one is. This was a... Okay, I took off the put side of NVIDIA today. So let's see, this trade was the March 17th, 242.50. I've collected 320, and looks like I roll up the put once and then close 13, so I'm about 307 in premium. It's still a little bit, again, this one falls in the 21-day criteria, so this is still a little bit of a loser, but it's out of the money, so I'm willing to sit on it. Let's see what if I would roll it out to, I don't see when, if I rolled it out to the 40.50, so I could roll it out for an 82-cent credit, and that's fine. That's a mechanical thing to do. I mean, this one is moved down. It was that call spread, as I recall, was in the money or near the money the other day. So that's one that following the criteria. What I do on these at the 21-day mark, if they're still out of the money, they've obviously got a potential that I can scratch them or break or make a little bit of money. I'll do that. But as soon as this thing gets inside here, Once it gets past 245, I'm not going to be able to roll it for a credit. So that on credit spreads, you need to be inside the spread and closer to the short side. I won't waste any time rolling this thing out like that. So, well, I guess I did something backwards, but I got to make sure I got a credit. So let's see any other trades I got on here that we talked about. Meta, Microsoft, here's another one. Rivian. I currently have, if you remember that one, I did that, a real chicken trade. I did a covered call, and then I bought a put. I locked it. The most I could lose is about 60 cents. Got 11 days left. So if I were, whether I'm long 100 shares of stock or short this 20 put is basically the same thing. So, I've got a short call that I need to roll down. Let's roll that thing down. That should be rolled down to about, see, there's not much money there, but I'll go ahead and roll that. I hate to even roll it for 16 cents, but 17, but that's a 20. Oh, wait a minute, I'm looking at the wrong thing. I would normally roll it between a 30 and 40 delta, so I'm going to roll it to that one. I got. So I'm going to roll that down. Roll that call down. Then if that call gets in the money, I might roll it out a week because that would make it a bigger losing trade. Shop is a strangle that I put on 257. I got to, let's see it. Shop was a 45.65 strangle. I took off the call side when it got trashed on earnings for a dime, and then I added a call side. They had 41.5, and this is something I don't do a lot, but I'll show it to you. I added a 41.5 call because I collected 257, so that gave me 257. Plus 215 minus 210, so that's 205. So I'm at 462, and the cost, and I've got to order. If I can buy this thing for 360, I'll make a buck on that trade. And again, my mission is to get the heck out of this thing. If I want to stay in, I might have rolled it out further, but that's unusual that I would roll a, do that. But effectively, what I did is because I closed the call, and then I sold it in the money call. It's just the same as rolling that call down. So Tesla, that's been in all of our shorts. See, I'm waiting right now for Tesla. I should put an order in there. So 180, 115. I'm going to put this in for 15. On Tesla, I'm going to put 1550 because I'd pay $50 to. I got wings on that because it takes so much buying power. So I'll watch this one. And if it stays in there and this thing whittles down to about $16, I'll roll the inverted strangle out if I haven't collected enough premium. I think I've got about $1,300 in premium on that one. So TZA is a covered call. Some of us have on UNG, VXA. That's really the positions I have on. How about some other questions that I can help you with? I don't know if I covered the inverted strangle. It's really pretty easy. I know you. I used to get it consumed with, okay, I don't have enough premium to cover the inversion. I've locked in a loss. But I hope I've showed that you can continue to roll out that inverted strangle, and every week you might be able to roll it out and even tighten it. Okay, Sheila. Yeah, because you can roll them out. If you can roll out for a credit, or you can roll out and tighten. Anytime you can tighten the inversion, if I've got the option of rolling out and picking up a $2 credit, or rolling out and reducing the inversion by $5, I reduce the inversion. I get, say, 20 cents for the roll. Because I want to get, what I'd like to do is get to the point where, gosh, I can't even remember which one it was. AMD. This thing gets back in there and we don't get filled, and we don't want to be out of it yet. I mean, we might be able to roll that thing out, like I said, rolled out to a regular strangle. So now we've gone from a strangle to an inverted strangle back to a strangle. And bear in mind, as you live through these things, number one, never second guess yourself. If you're just mechanical and you just, you position your call or your put, right at the money, one strike out of the money, one strike in the money, whichever side, whether you're bearish or bullish. And I know like on FSLR that Jan was bullish on. That's why I suggested to him, if you're bullish, I would put this, well, now it's even over 210. So at that time we were there, I would keep the call out of the money. Then I would play with the, for lack of a better word, with the put side to come up with a credit or zero here. Or, if it's a small debit, if you collected $500 in premium, it's worth it to have a little tighter margin. But there's, nobody knows what's going to happen, so you kind of have to put your own bullish. It's funny, in my case, I almost feel like I'm a perma bear because I'm always on the short side of everything, But for some reason, I don't like to be short calls. I guess it's that unlimited, where puts have a limit to the bottom, and I think puts always have more skew or more premium. You can roll them easier. So I'm always more cautious on the call side, and that's just me. People that are, and it's funny because I'm bearish. So when I'm adjusting a strangle, if you took even CRM's in the money. Let me see here. Let's just say I want to do something. Let's just say I'm going to do Chewy. And I got to buy this thing. So right now it's up, whatever, 49, 40 and a half. And let's just say, I don't want to mess with this thing for a while. I'm going to just go out a couple of weeks. And I would say, but I don't, if I put the call it's slightly in the money. If I'm, like I said, I'm less comfortable with in the money calls than I'm way comfortable with in the money puts. So I would probably go here. Then I say, okay, what put do I need to make this $6 to cover this particular, that's 39-cent debit. I go to here, 47. So now I collect a 36-cent credit. I'm down to a $6 inverted strangle. The call's out of the money. If this thing drops, the thing you got to be prepared for is, where all along the call side was tested. Now this thing's dropped. Your put's deep in the money. Now you're rolling your excuse me, you're rolling your calls down. So it's a strange world we live in. We'll start out with a trade that's neutral, and then we go inverted, and it may be even neutral inverted or have a bullish or a bearish delta on it. And then it goes the other way and you roll the puts up, and then it goes the other way, you roll the calls down. So it is kind of crazy. Okay. All right, let's see. Let me grab some water here. Okay, Robert, I had an inversion on Qs and now have it as a straddle roll into the. Are you telling me you're already on the April 21st expiration? Okay, so QQQ. You've got April 21. What strike straddle do you have? $98. You mean $298? Is that what you mean? Okay, so you're sitting right here. I'll ask you the question how much premium you collected, but the first thing that comes to mind here, number one, Robert, I don't ever like to get out this far when I'm on defense. If I'm on offense, I don't mind being out further. I don't mind being in April because we're putting on April trades now. But once you go inverted or you're defending a trade, I want to be as close, in a perfect world for me, I want to adjust it a week at a time. I want to roll out 1 week, and I want to collect more premium or tighten the inversion. And if I can do that, and hope that, I get lucky one of these weeks, I finally accumulate enough premium to cover whatever it costs to close the trade. It might even be a little bit out of the money. So once you get out 46 days, the way I feel about it, you lose a lot of flexibility. I mean, so I do it in small baby steps. I like to do it a week at a time. I don't know where you started. I think we talked about that on a call or something. I don't recall where you started, but I mean, I think if you've got a lot of premium you've collected, see, I would be, unless you've got an extremely bearish, if you got a bearish bias on this thing, then you could stay there and watch it for a few days. But I'd probably go from, and again, these decisions, while they're mechanical, and they should be mechanical, they're still driven by the amount of premium you collected, because your goal should be to either get out of this thing with a scratch or a profit as soon as possible. So you've kind of committed yourself at this point into being this long. Does that make sense to Sheila and Robert, some of you guys that are in here? I mean, I want to be in, once I've got, we put a trade on, we're on the offense, but once these things get breached or whatever, broken, breached, whatever you want to call it, now you got to play defense. And I would rather play defense 1 week at a time. Sometimes you got to go out a couple of weeks. The trade's gotten so far away from you, like Meta did on Friday, that then you don't, you can't keep a close handle on it. You might have to go out 2 weeks, say, to get a credit. But you see what I'm going to do with Meta. I'm going to go out, this week. I'm going to go out another week. Yeah, I mean, I think that's a natural tendency, Sheila, either to go out, and I've had coaching clients when I'm on one-on-one with them, and that they've gone way out to collect all this premium. But if you go, let me show you something. We'll take Robert's example here. The farther, let's just say we're at the money, 300 right now. Let's say we're inverted, $5 on each side, 295, 305. And then, so right now we've got a $10 spread, so we know that, that if we can close that thing for $10 or 10, 20, something like that, and get out of the trade, if we've collected more than $10 in premium, we're going to make money. But then some people say, well, I want to go out way wide and, go 15 on each side. And yeah, you collect a lot more money, but now you've created something that's going to cost you $30 to get out of. I mean, and I've done it too. If I've got a ton of premium, and I really want to get out of this week, and I can cover it, I might start at the center and go both ways, and let's just say I've collected $800 in premium, and if I got a chance of making it, I might go to a $7 wide inverted strangle with the price in the middle, crossing my fingers that I'll get out this week and be done with it. Because again, back to one of my initial statements is, I think that, once you go on defense, I think the mission is to get out of these things and redeploy the capital, either, as a scratch or a break even. But I mean, I just, like to your point there, Sheila, I found out the hard way too. I just like to go out week at a time. Well, not the IVR so much, but you don't know what, that's a factor. If the IVR is coming in, contracting, that's going to help the price of your short options. You're going to be able to buy them back for, a lot less. But more importantly, it's just I want to get out. an inverted strangle, isn't the place I want to be. I mean, it's a trade that it's kind of going to be in the back of my mind all the time. I'm watching it, I'm babying. I put on a strangle on a stock, and I put it 50% or 50% exit, and I may not even watch it for days. I don't watch it. Now once it's a strangle, now it becomes, it's uncomfortable. That's probably a good term. The more you get them, they're not comfortable anymore. They're the same as a strangle to me. If I've got an inverted strangle that's 10 wide, I've collected $12 in premium. It's a $2 win. I look at it as a $2 winner, but it takes some management to get there, oftentimes. But it's not so much the implied volatility. I mean, you do have the risk if you've got something coming up like earnings, where the volatility could spike and the implied volatility rank would spike. Now your options cost more money. So, that's a challenge there. But, I guess the simplest way to state is I started this thing out with a strangle. I sold it for $2. I want to make $1 on it. It went against me. I've managed it. Now all I want to do is get the heck out of it. And for a profit or a scratch. And when I say profit, sometimes I get tired with these things. I mean, some they get irreparable, I guess. But sometimes you just throw in the towel and say, I'd rather lose 50 cents or $50 on this trade and just move on, because they do take more of your attention, more of your concentration, attention, or whatever. So that it may be uncomfortable. I'm not so uncomfortable with them anymore, but they're kind of a pain in the what. So that's kind of the. But some of them, I've got some. You've probably seen some YouTube videos. I've got some that I've managed back and forth that have turned out to be huge winners. That is not the objective. To me, my first thing is get out, exit that trade, because I can always put on the other trade. Now I can go back to a regular strangle. I could maybe I take the same. I've got an inverted strangle like 292, like something like this. It's inverted. I finally get out of it. I still like it. Then I could put on a regular conventional strangle, at the same strikes or something, or whatever makes sense from a risk delta standpoint. So, but that's that. I don't have now. This one, I got to go back and look. I think this AA has just been all over the place. I can't remember how long. I think I've been in that one. I should look it up. So I should be able to get out of it maybe this week. Every time I think I'm getting out of it, like at 520 this week, I think I'll make 400 on that trade. But I've been in it way too long. I fought it way too long. So that's not the best use of your brain power or your resources, because if they get inverted and the implied volatility rank starts spiking, then they take a lot more buying power. So that's the thing. So, well, I'm glad it's helpful. Are there any other questions? I don't want to bore you guys. I guess we've been on here about an hour and 20 minutes. So I hope I'm going to record it. I'll try to clean it up a little bit. And you're very welcome, Robert. Glad to help anytime. I'll do this. Anytime you guys need help, I'm happy to. That's what the live room's for. We'd like to jump on the live room and use it for training. So.